continue to pay on these bonds, because what the British government was talking about is cutting taxes and increasing spending at a time when, frankly, interest rates were going up because of the fact that the Bank of England, just like the Fed here in the United States, was trying to slow down economic growth to get control of inflation. So it seemed like the two parts of the government were basically fighting against each other. On the one hand, you have monetary policy managed by the Bank of England, which is going one direction, trying to control inflation, and then you have the fiscal policy controlled by Parliament going in the opposite direction, trying to cut taxes and increase spending. So it seemed like those things were going in opposite directions, and it really spooked the market. As a result of that, bond prices dropped precipitously in England. Now, you might say, okay, well, that's just a kind of an academic thing with bonds. But the problem is you've got all these large investments that are made, for example, by pension funds and by other large entities into stocks and bonds. And what happened over the past few years, because it's been so long since we've seen interest rates going up the way they are, is that these funds were concerned about the fact that they wouldn't be able to generate the kind of returns that they need to be able to pay the recipients of the pension funds going forward. So what they did is that they engaged in some riskier investments. And if this is starting to sound like 2008, now you're seeing the picture. They engaged in some riskier investments that basically involved borrowing money against the investments that they had in bonds, basically using these bonds as collateral for loans, the same way that many of us use our homes for collateral for a mortgage, or our cars for collateral for a car loan. Well, what happens, though, is as the value of those bonds drop, then the collateral suddenly is not worth as much money. And this is exactly, again, what we saw happen when the value of houses dropped in the United States back in 2008. So the value drops. Suddenly you have the lenders saying, hey, you need to give us more collateral. You need to come up with something more for us because of the fact that that the value that's protecting us isn't worth as much money. That's called a margin call. Well, in this case, then, the problem is with so many of these institutions is that they invest most of their assets, most of their money into these long-term assets, these long-term investments. So it's not like they can suddenly turn around and come up with more money to pay off these margin calls. So what they have to do is start selling assets. What's going to happen when they start selling assets? Well, the value of the assets goes down again. As it turns out, they sometimes refer to this as a fire sale. Suddenly there's a rush to sell these things. The value goes down. It can be a great opportunity for certain investors, as you've seen, to pick up assets at very low prices. But the problem is these same investors who want to pick up these assets at low prices are the same people who invest in what's sometimes referred to here in the United States as junk bonds. And here's where the United States, being the financial capital of the world, really has its play here. We might say, oh, junk bonds, those are high-risk investments. But what we forget is a lot of the mergers and acquisition activity here in the United States and around the world is actually financed by junk bonds here in the United States. So an example would be the money that Elon Musk, speaking of Tesla, wants to borrow to be able to buy Twitter. Well, that money was going to come at least in part from junk bonds. And now all of a sudden, those investors are putting their money into these other investments, which means that suddenly he's going to have to pay a higher rate of return to get people to invest in these junk bonds. So it's going to cost him more to finance that. That's just one example. So there's only so much money out there to invest. And if money gets sent one direction, there's less money to invest in another thing. So that's kind of how it's impacting us here in the United States. But beyond that, though, again, if the British economy were large like the way the United States economy is, and if we hadn't implemented some of the changes to policy and regulations that we had implemented back after the 2008 crisis, frankly, we would be facing another 2008 style crisis, because although the Bank of England has said that by the end of this week, they're going to stop essentially their intervention in the markets to save these pension funds that were in trouble, long run here, there are some sleeping giants out there that we have to be worried about. And again, if you're remembering 2008, as I talk about this, you're in good company, because one of the big things that they have going on in England right now is a lot of mortgages there are adjustable rate mortgages, the famous ARMs that we had that kind of exploded here in the United States in 2008. Well, as a result of the increasing interest rates, suddenly people are going to have to refinance at a higher rate. They're going to have to pay more money. Some people won't be able to afford it. Suddenly, you're going to be facing a situation where people might not be able to afford their payments anymore. There might be foreclosures. Suddenly, some of these assets that were considered safe assets in terms of investments aren't going to be safe anymore. Suddenly, you're dealing with real chaos within the financial markets. And again, if Britain were a larger economy, I think that the world economy would be really concerned. As it is, they're a pretty large economy. Fortunately, though, not large enough probably to throw the whole world into financial chaos the way the United States did back in 2008, but certainly enough to create some heartburn for financial investors around the world.
Yeah, what happens on one side of the world certainly has an impact on the other, and whatever those impacts could be, could then have their own snowballing effects as well. We're joined by Michael Greiner from Oakland University on today's edition of the Megacast, our weekly market talk with Michael on the program. You can find all these from our recent episodes going back a few weeks on civiccentertv.com/megacast, civiccentertv.com/megacast. And so much of what we have talked about on these market talks, Michael, has been surrounding inflation and its impact on the U.S. markets and markets around the world, with it currently being at a 40-year high. And we've seen that the Federal Reserve, their primary way of combating that has been to raise the interest rates monthly about just under 1%, which in itself was a historical high of a raise at the first time it was through. Then it's happened second and the third time. We're expecting fourth and fifth going to happen as well. But now we're seeing some other members of the Federal Reserve, including their vice chairperson, Lael Brainard, has also said, maybe this is not the right way to do this, expressing some caution and claiming that actually these increases could slow the economy in ways that we may not even be able to observe just yet. What are the arguments that those on the Fed are arguing against some of these continued rate increases and some of those not yet to be observed effects that those could have on our economy in a negative way?
Yeah, that's a great question, and frankly, it's worth noting that these calls that you're starting to see from Lael Brainard and some of the others in the Fed, who, it's worth noting, they're very senior members of the Fed. So, I mean, these are people who are kind of central to the planning going forward. They know what's going on the inside. But what they're doing is that, number one, they're not saying that they're going to slow down the interest rates yet. I think it's pretty much at this point, especially since we got another relatively high inflation report recently, it's likely that, as you say, that in November and December, we're going to see another 2 rounds of 0.75% rate increases. So, I mean, that's probably going to continue for the foreseeable future. But there is this concern that we've been hearing more and more, not just among these two members of the Feds, but actually it's something that we're hearing globally. Because you have to remember, the Fed's not the only central bank that's raising rates. I mean, we just talked about how the Bank of England is doing it, as well as, by the way, also the European Central Bank is doing it. So this is not some thing that's isolated just to the United States. And as a result of that, what's happening is borrowing is getting more expensive around the world. Now, how do we see that impacting us here in the United States? Well, the most direct impact that we see is in mortgage rates, which have been going up very, very quickly. Anybody who's looking at buying a home right now will note the fact that mortgage rates have been going up quite a bit. And as a result, by the way, I've also noticed that the values of real estate have been going down. Where it wasn't all that long ago that homes were selling for historic prices, and it just kept going higher and higher and higher, and they'd frequently be multiple bidders for any home that was on the market. That's not the case anymore. In fact, now more and more, you're starting to see people having to lower the price of their home to be able to get buyers because of the fact that interest rates have gone up. It's harder to get mortgages now; they're more expensive. Well, as a result of that, you can see where there will be some slowing down of the economy. I mean, frequently people say, oh, the increases in interest rates, they will slow down businesses borrowing to be able to invest in capital goods, or they will make credit card payments higher, or they'll make car payments higher. And that's all true. But the fact of the matter is, those are relatively small changes. Reason being that for most capital goods, businesses will borrow over short term. So they aren't paying as much interest, for one thing. And secondly, usually when they're investing in a capital goods, because they need it for their business. I mean, so they're still going to invest in it one way or another. And in terms of the credit cards and car payments, those amounts are relatively small, somewhere from $25 to $50 a month extra per household. So relatively small amounts of money we're talking about. That's not the case with mortgages, where an increase of a couple percentage points could be the change of $400 or $500 a month in mortgage payments. So a substantial difference that could really impact the amount of home that people are able to buy. Well, what that means then is suddenly all this activity where people are constructing homes is going to start to slow down. And we've seen evidence of that, where there are fewer housing starts that are going into effect. But the reality is that you've got all these houses that are already in the process of being built. It's not like they're suddenly going to stop building them simply because some of the buyers have dried out. So over time, you're going to see these homes being completed and fewer homes coming to be built. And as a result, there are going to be some layoffs then in the construction industry. There are going to be fewer purchases then for some of the goods that are used, say for shingles or for bricks or for concrete or wood or anything like that. And as a result, suddenly the prices are going to start going down for those things. And that's going to really start to put the brakes on inflation. Because you have to remember, real estate is anywhere from 30 to 40% of the American economy. So it's a substantial part of it. So as those things slow down, then you're going to start to see interest rates start to cool. The problem is it doesn't happen immediately. They make these interest rates, and because of the fact that they've got these houses that are already being constructed, then that's going to go on for quite some time until finally they start running out of homes to be constructed. So that's what I think these people are pointing to, is that there's this lead time between when the interest rates are increased to when the impact is felt on the broader economy. And the concern is that if they increase them too much, it might throw the economy into too much of a recession, more of a recession than is required to deal with inflation. And that's kind of the concern that you're starting to see raised by a number of economists, including these kind of insiders at the Fed right now. And it just shows that this is a complex balancing act that the Fed and the other central bankers are playing to try to balance the needs of a growing economy with the needs of us to basically get inflation under control.
This is all part of our Megacast Friday Market Talk with Michael Greiner from Oakland University. More information on the Oakland programs can be found at oakland.edu, oakland.edu. And as we talk about financial crises now and similar financial crises we're seeing across the Atlantic Ocean in Britain to what we saw in 2008, one of the people that helped us through that on the economic side was Ben Bernanke, who recently received a Nobel Prize in economics. And he is one of your economics heroes.
He is, Michael. Actually, yes.
So tell us about his contributions to economics that make you such a big fan, and why this is such a great honor for him to be recognized for his contributions that really helped to save our economy from dipping into a depression era sort of situation that it was certainly projected to be in back in 2008.
It sure was, yeah. And Ben Bernanke, he won it along with two other economists, who basically, the three of them, starting in the mid-1980s, had basically worked to try to explain why bank runs happen. And a bank run, for anybody who's seen the movie It's a Wonderful Life, you know what a bank run is. That's kind of the crisis that the hero was dealing with, where all of a sudden he had to come up with money to pay the depositors who were concerned about the bank not being able to pay them. And the problem that banks deal with, and this is kind of what the three of them explained, is the fact that banks are kind of an intermediary. They serve as this intermediary between people who have money and people who need to borrow money. And each side has different concerns. Number one, the lenders don't know much about the borrowers out there. So they don't know who are going to be better credit risks and who are worse credit risks. That's the first piece of it is. And then the second thing is they want to have a certain amount of what's called liquidity in their investments. So what they want to do is they say you deposit money into a bank. You don't want to go to the bank and say, hey, I want to withdraw $100 from the bank, and then have them say, okay, now you need to wait 6 months to be able to do that. That's kind of the concern that the depositors, the people with money, have. The people who need money, though, kind of have a different problem. What they need is that they need to be able to get a bunch of money at once and then to be able to pay it back over a long period of time. So what that does is it makes that this money is suddenly not available to the investors who want to be able to have access to it as they need it. So what banks engage in is that they engage in a process of what was referred to by these economists as maturity transformation, where basically they take these investments, and by kind of able to kind of keep a certain percentage of it on hand to make it available for people as they want to withdraw funds, and lend out the rest of it. And kind of by playing this game of keeping a certain percentage of the investments on hand and lending out the rest of it, they're able to kind of satisfy both sides. Aside from the fact that by engaging in this and kind of consolidating all these investments, and then also consolidating all the people who want to borrow money, they develop a certain knowledge of who's a good credit risk and who's not a good credit risk, and can kind of, funnel the money from the investors that they make to the places where it's going to be more secure. Well, the problem is, though, is that if at any point you get into a situation where suddenly the investors start to be afraid that the bank is not going to be able to pay back the money that they've put in there because the people who have borrowed it aren't going to be paying back the money, then what you get what's called a run on the bank, where the investors all of a sudden all start saying, hey, we want our money back. And as we said earlier, the banks only keep a certain percentage of on hand. So once they run out of that, they don't have the money to pay the investors. Well, that happened back in the Depression, obviously. And the way we dealt with it was the establishment of deposit insurance, with best known the FDIC, but there are other deposit insurance companies out there. And what they do is that they basically say, hey, if the bank runs out of money, we're going to step in and cover the difference. Well, the problem that happened then in 2008 is that we had a development of what's been frequently referred to now as a shadow banking system, which is, although banks have deposit insurance and all these regulations dealing with how they lend out their money, other investment vehicles had developed that didn't have those regulations. And it turned out that kind of shadow banking system was huge, way bigger than the regular banking system. So all of a sudden, when you had a situation happen where people became concerned that these shadow banks weren't going to be able to pay on their investments because of the fact that they'd invested too much money in home loans that turned out not to be as secure as people thought they were, then all of a sudden there was a run on them. They had to pay them back. We had what we talked about with Britain, where suddenly these investment funds had to be having a fire sale of assets. The value of assets declined, and suddenly you went into this chaos here. Well, Ben Bernanke, and this is really why I'm such a fan of his, as a student of history and as a student of the Great Depression, he recognized immediately what was happening. He knew that this was a classic run on the bank at a time when, frankly, most people didn't recognize that. And he knew that the most important thing that had to be done was to provide liquidity. That basically the Fed had to step in and make sure that you didn't have this widespread failure of these intermediaries because they weren't able to pay back what the depositors wanted. So he stepped in and basically said, we're going to do whatever it takes to make sure that the American financial system essentially stays in operation. Now, a lot of people got angry about the perception that he was saving these bankers who'd kind of made bad bets and who probably should be held responsible for the chaos that they caused, which I agree with, by the way. But the problem was he was kind of morally torn by it himself, actually. But he realized that the bigger risk that we had was the entire United States and, frankly, the entire world economy collapsing, which we came dangerously close to in 2008. And really, if there's any one person we have to thank for the fact that it didn't, it's Ben Bernanke. So that's a big part of the reason why I think he's somebody who is well deserving of receiving the Nobel Prize in Economics. And I was really happy to see that announcement.
Well, Michael, we appreciate you coming on and talking to us about all these different issues and certainly give us a nice history lesson there briefly on the impact of Ben Bernanke on the U.S. and the world economy. Thank you very much for joining us.
Happy to be here, Tyler. Have a great weekend.
You as well. Oakland.edu for more information on programs at Oakland University, including some that are ran by Michael Greiner. Well, that'll be it for this week's editions of the Megacast. You can find more information on our show by visiting civiccentertv.com/megacast, where you'll also find our full shows and individual interviews on demand, as well as those helpful links to different TV, radio, and streaming outlets that join us all across the Great Lakes State in your local area 5 days a week, live and live to tape. Also, go to our local news page to keep up to date on information on COVID-19 directly from reliable resources at the Centers for Disease Control and Prevention at the federal level, the Michigan Department of Health and Human Services statewide and locally, where we originate our broadcast from the Oakland County Health Division. You can also find articles on a number of different topics, both on the COVID-19 front and beyond, from across Michigan on our local news page. Click through to read those articles in full. And of course, access their supporting materials and other news stories. And if you have means to do so, we highly encourage you to subscribe to these publications and support local journalism in your area. Big thank you to all of our guests this week, as well as our dedicated crew at the office of My Michigan TV, Calvin Brown and Jared Clark at Master Control, as well as Larry Nyland, our producer, helping us book all these guests and getting both the guests and us informed for ready for informative conversations on a number of topics every single week. That's it for this week's MegaCast. We'll return next week with new editions of the show.